In this video, I'll explain what depreciation is all about, and I'll show you how it works. Let's imagine we have a business and we've done $100,000 of sales in the year, and we've incurred expenses of $60,000. These are our operating expenses like the annual rent, the annual salaries, the annual internet bill. So our profit in simple terms for the year is $40,000. Let's now imagine that our business buys a machine. Now, I'm no artist, so I will represent the machine as this box with an M. And we spend $50,000 on this machine, and it's going to last for 10 years. Now, I might be tempted to record that purchase of the machine like this. That's another expense that we've incurred. So now we don't have a profit of 40, but we have a loss of 10. That, however, is not the correct approach. We need to follow the matching or the accruals concept. This says that we won't recognize revenue and expenditure when cash changes hands, but rather we will match revenue and expenditure into the period in which it occurs or which it is related to. So what we will do is this. We're going to take our machine, which is going to last more than 1 year. It's a long-term asset, so that's a non-current asset. What we're going to do is match this cost to all the accounting periods where it will provide benefit. So I will take the $50,000 and we will divide that by the useful life, and then we will have a $5 charge, $5,000 charge per year to record the depreciation of our machine in our P&L. So that is depreciation. It's application of the matching concept to a non-current asset. We will then match the cost of that asset to its useful life. Now, I've shown you straight line depreciation in a simple form. There are other approaches to depreciation, but our depreciation charge will be $5,000 for the year. So now we could add a new expense. I'll abbreviate it like that, depreciation, 5. That would bring our profit to $35 for the year. Friends, that is depreciation in a nutshell.